You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. If we sound a little bit different, it's because we're coming at you from the Options Industry Conference here in scenic and sunny Miami. You got a great slew of guests lined up for you guys all week, so stay tuned to the network. Lots of fun stuff coming your way, including our next guest. Well, it's up to him if he's fun or not. I guess we'll find out. He's an old friend of the network, Mr. Henry Schwartz, the founder of Trade Alert. Mr. Schwartz, welcome back to the Options Insider Radio Network, sir.
Thank you, Mark. It's good to see you. It's always great to do your shows because I listen to them all the time, and sometimes it's nice to hear myself.
You're the one guy. Whenever I see every day, download one. It's always Henry. So there we go. Now I understand how it all works. Yeah, this is fun. We get to meet face to face once a year here at this annual gather. It's always in a room just like this. You know, the rooms never change. We could be in the most exotic locale in the world.
Yeah, but you have windows this time.
We do have
windows.
This
is a big step up.
This is huge. This is big time. We're moving up in the world. Which is fun. But you're here doing some fun stuff too. You do the annual check-in, the annual state of the options industry, aka the most depressing. I joked with someone earlier today that you have one of the most depressing slides every year, which is that graph of how many names comprise half of the volume.
Oh, yeah.
And it's always smaller every year.
Yes. You know what? It's funny. I mean, I go to all of these, and I know a lot of people have to go to all of them, and so I don't want to do the same things over and over again. So I update the existing slides, and I try so hard to come up with something new, because otherwise I'm like, fine, we got add one more year onto a 10-year slide. But there's a lot to talk about this year, really, and in my 15 quick minutes.
Well, we'll give you a little more. We'll give you 17 here if you really need it.
That's you know what, when I run out of time, I will tell everybody, and for the part that I didn't get to, just listen to the Options Insider.
Exactly. There you go.
So but there's a lot to, we were talking about last year's volume, which was, everybody knows, a huge
something happened
setter.
last year.
Something happened last year. It wasn't like the year before.
I was busy.
It was we had 1 week. I was just looking it up on the plane. February last year was when the vol apocalypse happened, and one of the guests, later on this panel we were talking about is Blair Hull, who I worked for. And when I worked for him, I started in '89 on the SIBO, and I was like, okay, I'm going to compare the February 6th week of 2018, which is when the wheels fell off the bus, to the first year I worked for Blair. Okay, so we did
a very personal bit of analysis. Exactly.
So the volume that week was 206 million contracts that week, and that gets you through about 10 months of 1989. So it's really pretty amazing to see how far things have come. So I will mention
an order upon order of magnitude.
I wanted to be able to say that 1 week did more business. We did more volume than Blair's entire fourth year in the business kind of thing. But it didn't quite line up. So
10 months. It has a decent ring to it.
Exactly. I guess I could go back to when he was like brand new on the P-Coast floor, which was probably 81.
Which is now NYSE West. I don't know if you've heard.
I've heard about it. I want to go see it.
Rechristened.
It sounds nice. The Amex new floor is nice. So they're giving the floor a nice.
I just wonder if the biggest selling point for the P-Coast was always you could go down there and eat burritos, right, anytime you wanted. And I don't know if you can do that in the new NYSE West. So maybe they've taken a step down.
I don't know. If it's like the Amex, it's really nice and really densely packed. like meaning it's very small.
Oh, I don't know how densely packed
it's
this one
dense
is.
because they took what was an exchange floor and they kind of made it into like a 2,000-foot exchange
broom
floor.
closet.
But I will go see it if I can get somebody to let me in. So.
Yeah, I do want to check it out. Speaking of checking things out, sir, you have been, like I said, you've been doing this kind of state of the state for a while here. Any interesting trends? What leaps off the page at you this year outside of the 10 months of Mr. Hull's career there?
What stands out the most is volume is going to be down this year unless something happens in the second half of the year.
By the way, before we keep going, does that surprise you at all? Because I mean, we were prognosticating about that a lot on our network in the early part of the year. I did some panels at some industry events beginning of the year in January, and everyone, to a person, was raising their hands in the room saying, "Oh, we're going to blow the doors off last year." I thought it seemed like a little bit of a heavy lift to be able to do that, and I'm curious if you were feeling that way. How did you vote in our polls early in the year? Is what I'm asking.
I don't know if I voted, but it didn't surprise me that the volume's going to be softer. I mean, last year had February and also into the end of the year was incredibly busy, and you kind of had these dislocations that kind of cause a couple 100 million contracts to trade just because it gets so insane. The one thing so what jumps off the page at me though is even though it looks like volume's going to maybe down 7 or 8%, it's still going to be 4.7 or so billion contracts, which is going to be the second best year. So it looks like we're still tracking to be ahead of 2011, which was the prior record. So what jumps out at me, really, even though the volume this year, it does look like it's going to be down, say, 5 or 6%. It's things have been slower. You still have, interestingly enough, single stock option volume looks like it's going to be up on the year, at least so far. Which is so really the decline is coming in the ETF and the index complex. And that's interesting. I mean, on a down year for single stock to be up, and it'll be the third straight year of an increase in single stock option volume.
That is interesting. You're right. We have seen those numbers come out of OIC every month, and you're right. The index declines have been somewhat precipitous, and the ETFs have not been doing too well. Obviously, the futures in places like volatility futures still have never recovered from the debacle that was the VIX-ocalypse, call it what you will. But that is interesting that we would see single names trending up, and yet the aggregate trending down. In all of your various parsing and analysis, sir, what do you attribute that trend, sir?
I mean, I think that it's in a way it's the kind of the pendulum swinging back towards there's a lot more interesting things going on in single stocks. You do have Lyft and Uber, and you have IPOs happening or whatever you want to call them. Maybe they're not quite the same as the old-fashioned IPOs, but I was at another conference last month, and somebody from the NYSE mentioned that one of the big concerns is you have a much smaller amount of companies IPOing in this decade than we had 20 years ago, and to the tune of there being a couple thousand fewer stocks to trade, so. That business picking back up, even if it's picking up in a slightly different form, where the private equity is basically using the IPO as an exit, you get things to trade, things that are high profile, like Uber and Lyft, that people like to trade. So I think it's coming from that. We're also seeing some interesting growth in the non-equity ETFs. So GLD, USO, HYG, is a huge one. It's interesting to see those products, which people are able to trade in an equity account. You don't have to, they're very popular. I mean, the international stuff, right? FXI, EWZ. These things trade really liquidly, and then you get kind of the snowball effect, because if there's a lot going on and the markets are very tight, more people get pulled into it.
I kind of wonder, we've been hearing so much data anecdotally for the last few years, right, and empirically about how everyone's going passive, right? Just 80% passive, 85% passive. Maybe some of this data is maybe showing that maybe the cracks are starting to show in that dam there, where because obviously if they're trading more single name options than the large indices, that implies a level of stock selection at the very least, right? So that would maybe have we crested that wave, you think? Is it starting to move the other way?
I don't know. I mean, I have heard some smart people talk about how indexing is overdone, and indexing is great unless everybody's doing it. Then it just becomes stupid. And there, at the same conference, somebody was comparing the performance of, because especially in these cap-weighted indexes, you end up with some very strange, all the money goes into into Apple, right? And so that becomes kind of a self-fulfilling, flow. And there are people looking at, what's happening to, the lower cap companies are not getting the attention, right? Because it's passive. You're just saying, I just want to do what the market's going to do. But if everybody's saying that, nobody's really taking any care about where their money's really going. So, I guess there's probably two, it's flowing both ways, right? You still have the millennials, they're just used to just putting their 401k into an ETF and not thinking about it for their entire career. But then, you see these little startups, right? Robinhood and Ally and all these things that are pulling people into trading again, which is nice.
That is nice. Otherwise you and I would have no more business. And then we would have to be off maybe working at a fine hotel like this, making sure other conferences could go off without a hitch. That is, I haven't seen, I'll have to go dig in some of the numbers myself and see some of that, anecdotally, what is potentially driving some of that single name influence, because you're right, that for so long the trend has been in the other direction. I kind of stopped looking at it for a while there.
Right.
And
well, you mentioned the concentration, the depressing slide.
Yes, my favorite slide every
last
year.
year we had 102 names doing 80% of the daily volume. Okay, so that's 3% of the listings. So the 80-20 rule becomes the 83 rule. This year it's 133 names that are used in the top 80%. So that is
a reversal. So I'm not as depressed.
Yes, that's
as I was
30
a
names
year ago.
Squeaking in there that are trading more actively, and some of that's coming from.
Is that the first time since you've been doing this that's been the case?
That's the biggest increase in a while, I think, in about 4 years. So I don't know. I'd have to go back further to figure out, what it looked like 10 years ago, how many names were in the top 80, top 80%. But, it's coming from new listings. Lyft actually is in the top 25 names.
Lyft actually does some decent paper. Yeah. The ADV is actually, and it's maintained it. And a lot of times you get the IPO, you get that, surge of interest, and then look at Pinterest, and then they're off to the next thing.
Right.
Lyft has maintained it for quite a while, which is kind of interesting, I think.
Right. So, and then you also have a lot of, the RevCon business is continuing to kind of pick up, and part of that, there were some big tenders, so that gets, gets you 10, 20 million contracts over a month's time. And interest rates going up, and is also kind of pulling people into RevCons to kind of adjust their balance sheets.
I was talking to someone from an execution desk the other day, and, they do ETFs and options and a bunch of other things. I said, what's the hot thing? What's everyone into these? What's everyone looking for you guys to put up? He said, boxes in the S&P. I said, what is it, 1998 all over again? Really? I didn't know market-making firms would even quote those for you. The capital rules are so prohibitive on that. But apparently that's everything old is new again. So, boxes. Who knew? So maybe that's where all your data is coming from. Size boxes driving the numbers. By the way, I take back what I said earlier about your slide being the most depressing thing. This year, it is indeed uplifting, sir.
Okay, well, I'll do my best because last year there's a big difference in the mood this year versus last year, right? Because last year, it was the end of the first quarter. Almost every desk I know made a fortune in February of last year. To the point where I'd say how
the ones that didn't blow out horribly. They're
right, but there were like 3 that blew out, and there were a couple hundred that did great. And I was talking to a couple big banks that like, we made our year by March. And the end of the year was much rougher on people. That December slump, a lot of people weren't paying much attention. It's when you get a sell-off into year-end, it kind of screws with everybody's head because they're like, well, we were up 14% year-to-date, and now we're going to finish, down. So that kind of finished the year on a down note for both buy side and sell side. And the couple people that I've already talked to here are not having the greatest quarter this time around. So, and it's funny. I asked them like, so why is that different? It's funny because, we had a big vol spike in February and everybody said they made a fortune. We had a big vol spike in December and everybody said they got hurt. And I said, what's the difference? Like, well, the first one happened, first of all, early in the year. So you weren't kind of expecting the year to stay as it was. you had some room, right? Nobody's going to really start redeeming money out of a hedge fund in March. They said that the speed that volatility kind of spiked and kind of went back in February worked out a lot better than what happened in December, which was more people are kind of saying the vol was actually kind of sluggishly reacting. VIX didn't go up to 40. Market was down 20%, over a few weeks, and VIX was in the 20s, and people were like, this isn't how it's supposed to work. So that kind of messed with a lot of the buy side, because the buy side was, wait, our hedges didn't work out, so maybe we shouldn't be hedging anymore. And then just the fact that when it happens at year end, it screws with everybody's plans.
Yeah, when the nadir is Christmas Eve, right? You don't exactly have the senior guy on the desk right there, right. ready to buy the dip on Christmas Eve, and with both hands, which is apparently what all of us should have done, because that was the day.
I missed my chance.
But yeah, it has been strange. I think strange is a good word for it. Strange environment to look at, and we had obviously the VIX apocalypse, and obviously these firms can't rely on a VIX apocalypse, every quarter, to make their year. that would be probably pretty damaging for the market overall in the long term. But you're right. Also, by the end of the year, we had already seen the VIX apocalypse. We had seen the big crazy sell-off in October. So we had seen a couple of spikes. By the time you get to December, right, you're kind of jaded, right? You kind of seen it. You've seen it. You've been there. You've done that. Got a terrible T-shirt probably. And so by Christmas Eve time, you kind of maybe you're a little inured to the whole thing, which is probably why it didn't maybe perform as well. And everyone else was all short VXX, and look how well that worked out for Jan expiration. Not so well, sir. So yes, you got the depressing slide is not depressing, which is a nice change. But what are some other changes you spotted in the data this year, sir?
Let me see what I got that was exciting. Complex orders continue to be a big part of the business. That's kind of for single stocks. It's kind of hang out in the 30 to 35% of daily volume is in complex orders. Market quality is also one that people, are kind of always trying to pay attention to. Are things getting wider? And that's one that's kind of depressing, actually. Because, what, I look at it and I'm like, okay, fine. When VIX spikes, when volatility gets crazy, you widen out your quotes, and that's acceptable. But then when VIX kind of comes back down to earth, you expect the quotes to narrow back down. And so what we're seeing is that the quotes are not coming back as tight as they were, a few years ago when VIX was at the same level.
Could auctions be gaming those numbers a little bit?
I mean, auctions are one of those things that disincent tight quoting, and I do think that's a big negative for the business. I mean, you talk about these disruptors, positive and negative, and auctions. I think the banks love them, and some customers really love them, but this unintended consequence of like, well, gee, if we're just going to trade mostly through auctions, why do we need to quote tight?
Yeah, who needs to show their best hand?
And that hasn't that hasn't improved as much as you would kind of hope it would.
So I take it back. That's the most depressing.
That's
slide.
I'll even mention. I'll say here's our new depressing slide. Something new to worry about.
Market quality. There we go.
And I mean that's it. I mentioned to you before. We're excited because Opera is rolling out new condition codes in the data, which for people like me that kind of spend our whole day trying to make sense, and you, of like, okay, what was this trade, and like, you see a mid-market block and you're trying to make sense of it. Was it tied to something? Opera,
pretty much everything in VIX.
Yeah,
all mid-market exactly.
And I'll tell
tied.
you, for VIX and for SPX, I don't know if it's going to help very much. Most of the new condition codes, they're not. Unfortunately, they didn't ask me when they came up with these. I would have said, here's a couple of things you should do, but they're not elaborating any on was this a straddle or combo. But they're doing much more to make the what's trading in the form of auctions and what's trading in the form of spreads tied to other spreads tied to outrights is going to be identified. So actually, I guess in SPX that will help because there's so much trades tied to combos. So you'll be able to say, okay, well, this does match something, but you're still kind of in the same boat where you got to go figure out what it matched, which is fine for us because that's what we build systems to do. But there'll be all sorts of good information,
more insight into that is obviously a good thing, not just for what we do, even though it's nice, but
right.
But for everyone out there is trying to parse it. We see it all the time. People are like, what does this mean?
Well, it's like a double-edged sword, because one of the other bright spots for recently is the flex option volume. Right now, I love flex. Some people are like, get off the flex, but. There was a record.
Did they happen to run some big OTC desks?
It was a record quarter. For the first quarter, I think over 12 million contracts traded, and I think there's a lot of potential for that product class. What you mentioned is correct. The OTC traders don't really want flex to thrive, because it could potentially take away the OTC business. But the other thing about the flex is the more I talk to traders, part of why they really like it is because it is hard to get your hands on the data, right? That flex data is not nearly as real time. There's not two-sided quotes necessarily to know what the heck is going on, and they like it that way. So that was another one that was a positive.
There's definitely a certain element of the market that likes a little bit of opaque nature to what they're doing. The same people who argue against real time open interest. We're getting those questions again.
I heard you.
I was almost going to forward you, because we've gotten a bunch of them again. I don't know why. It's the season apparently for real time open interest. But I had some conversations with the OCC folks today, and they were not as dismissive of it as I thought. But which is kind of interesting. What are your thoughts on that very contentious issue?
I mean, it's funny because I don't think technologically there's any trouble at all, right? Because they're clearing these things in real time, or within seconds of the trade. Unfortunately, I think there'd be a lot of resistance to it from the banks. One thing that I do hear, because our business is kind of adding transparency to the process and making it clear that somebody just swept 6,000 calls through the offer. If you go overboard and, let's say somebody sweeps 6,000 calls, but there's 10,000 open, and you're trying to figure out, like, well, gee, you could use, our approach is let's go back and look at the history and say, okay, well, I don't see anything else even close in size, so this is new. Or the 6,000 that are already open were created through buying over the last 3 weeks, so this is additive. That's what people do now. If you knew when that trade hit that this is a closer, the slippage, that customers and banks fear, the transparency makes that worse. When people don't quite know what's going on, they can't, try to front run the hedge or jump into.
They can't fade you.
So. I think that's where you'd run into trouble, is that people will be like, no, because my customer thinks that if everybody knows this is a closing trade, that they're going to just move the price out of the way because, like, now this guy's got no choice.
Yeah. That definitely is kind of the gist I got, that it wasn't as much a technological issue as it was maybe impedance of other types that are holding it back. But it is a strange, dichotomy. Particularly for a lot of the retail, right, who've come up in the last 10 years or so, right? They're used to hitting a button, and their trade is done before the button's even almost pushed. That's how fast it is. And then you have to wait 24 hours, to see what, the net change of the OI. It is a strange thing for a lot of people to wrap their heads around.
It's been anything that's been kind of static for 40 years is probably not kind of what you'd expect in this business. It's possible if some asset class moved towards that the other, like let's say the CME or something started doing it with their products, and it might draw in. I mean, that's what's funny, right? The transparency on the big scale, people like transparent markets. So it's healthier for the market for everybody to know, okay, these calls were just bought to close. Okay, now there's information out there, but for the one guy trying to buying those calls, and right now those are the ones that are kind of making the most noise. So I don't think you're going to see that anytime soon.
Maybe like an intraday update at some point, and here's the noon OI update, and then here's your typical end of day 24-hour kind of update.
Well, I mean, and the other thing though, I would be great. Anything would be great. The one argument for doing something like that is that in a lot of cases, if the members of the exchanges can see more on the order that they're transacting with than everybody else can. So if, like a good example is, there's one clearing firm which if you use them, when you make a trade, you can see the counterparty clearing firm that you traded with. Okay, so let's say you're a market maker and you're making a two-sided quote, and all of a sudden you get lifted. And if you can kind of, it's kind of similar to like, if you were in the pit and you're like, oh, this guy that trades the 511 lots, like he's trouble.
Everyone loves that guy.
Yeah. So they know that they traded against. Now, in reality, all the clearing is Goldman and Merrill, so you don't necessarily have a ton of information. However, these guys told me that that some accounts that do clear Merrill have additional information in the record. So when they trade and they get their clearing record within a second or two, there actually can be an account number embedded in this extra field on the clearing record. And so, in a way, you say, well, that's not really why does the counterpart? Why do the two sides of the trade know that? Why can't the rest of the world know that? So, maybe you could kind of go at it that way and say, look, if whatever, some market makers got this information that's very useful. Is that what you want in terms of the leveling the playing field? So, but I wouldn't hold my breath.
It doesn't sound like you're too optimistic on seeing this anytime soon. Ironically, I did also mention to the OCC folks about after-hours options trading, another thing we like to talk about down at this conference. They seem more optimistic and less reticent about that than I kind of would have assumed.
Yeah, but SIBO has overnight SPX and VIX options, and if you talk to a couple of the brokers that are down there, they're very unhappy. Not that there's no volume, but that if they want to do brokerage after hours overnight, they need not only they need to have a crop on the desk, so an option principal for regulatory. So you're not allowed to be doing brokerage unless you have compliance, and it needs to be a human being. So now all of a sudden it's like, well, gee, you can't just have two people. You got to hire like 3 or 4 people for this business that doesn't seem to be there. So like one of the brokers I was talking to said, nobody really thought about that when they decided, okay, let's have this thing start trading at 2 a.m. And that's really why you don't see the volume.
Yeah, they mentioned that there might be some nuances like that you have to work out. Like, for example, there's like some $10 million account minimum that they have to have for some sort of clearing member type thing that they would probably need to get rid of in order to make it a little bit more level playing field for everyone. But yeah, interesting little nuances like that I think are kind of fascinating. Also, SPX doesn't have earnings after hours, right? You get like a Google and Amazon in there, some others, and around the time of earnings, maybe like an earnings pilot.
I mean, I could see doing 2 hours after. Nobody's leaving at 4 o'clock. So. But they tried that when I was at B of A. They had an early open for in the late in 2000-ish. They did an early open. I don't remember an hour. They opened an hour early for about a year.
Oh, I do not recall.
And nothing traded.
I missed that pilot, sir.
It was just annoying.
That was pre-Options Insider. I don't know if you know that, but anything that happened pre-Options Insider is lost to the murky ether of time. Doesn't count. Doesn't count at all. What does count, though, is what you guys are working on over there in Trade Alert land. I know you're excited about these condition codes, and it is very exciting.
It's really exciting if you're me.
What else do you guys have up your sleeve?
I think I mentioned this last time I saw you. So we undertook a big web page. I wouldn't even call it a web page redo. It was just a annihilation of the old website. And integration of that functionality into our little pop-up window, which sends the alerts and provides the recaps on activity. People used to use that, and they'd go over to the web page, and they could do queries and get bigger data sets. It's all now one nice app, web app that lets you basically pop off a nice little charting widget, a nice little query widget. And then you have the ability to just single click download everything. So it's exciting. Though the old web page we're still hanging in there while we make a few more little changes, because when we say we're taking away this 15-year-old web page that nobody should like, there's some people like, wait, I like the web.
So no more clicking on the Trade Alert icon and going. It's just going to load automatically the applet.
It's all going to be part of the app. So. I set you for beta, so you'll see the little thing the next time you log in, and it's nice. It's much more streamlined. It makes more sense for the way people use us.
We're dealing with our own web issues right now, so I can empathize with all of your growing pains on that front.
Yeah, it's never done either, right? You do it, you're like, oh yeah, this is great, and then you realize it's going to be a permanent development project because you kind of have to keep evolving.
Is it now? I know we get questions about this. I'm sure you have as well. Because you have that applet, and you used to have the web page. Obviously, that's transitioning to the applet. Have you thought about leaning more in the mobile kind of side as well? I know that is there ever going to be a Trade Alert app, perhaps?
The applet
is
works.
It responsive?
Yeah, it's HTML5. It works great on a phone. So and you can turn that into a true app, but there's not really any reason. It's just a browser. So to me, it's like I think I probably have about 80 apps on my phone, and you realize like, well, you don't need the American Airlines app if you can just go to American Airlines on a browser, and then you realize
you want to have that on your phone 24/7 just in case.
Right. All you need to do is bookmark us on a browser, and then you can get everything. So that's exciting. It's nice, kind of bringing out new stuff, some new charts that you'll like, vol term structure and realized versus implied, that kind of stuff.
What about the land of what's trading for the retail friendly folks out there? What's new on that front, sir?
We continue to do what we find to be helpful to kind of individual traders at westtrading.com. It's still a kind of a nice way to get your toes in the water. A lot of people, our main tool is designed for institutional users. So there's not a lot of help there. It's not as intuitive as What's Trading, which is designed to be what kind of your normal semi-professional would like.
But the Trade Alert has all those cool noises, which is any retail.
That's why we charge more for the noises.
Like, what is the laser blaster going off here? I've always got the new Trade Alert going. That's what it is. Well, sir, it sounds like a lot of good stuff. Fewer depressing slides than last year. So maybe it's like the old, Greenspan briefcase indicator. How many depressing slides does Henry have? Oh, he's got fewer. Okay. So the industry is in an upturn then. That's a good thing. I
think so. I think it's a healthy. I mean, last year was great, but I don't think anybody expects us to continue, 22% growth year over year. That's amazing, and it happens every once in a while. And now, if we can pull back a little bit, but maintain, the kind of the trend up, then we're in good shape.
Sounds good, sir. I'm looking forward to your State of the State tomorrow. Listeners, you can catch it all after the fact if you didn't make it down to Miami here on the old network with all the good panel audio coming out very soon. I'm looking forward to seeing all these exciting condition tags coming out soon, sir, in the land of Trade Alert.
Awesome. Thanks, Mark.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.